Capital management stands as the cornerstone of trading success, often underestimated by novices, yet recognized as vitally important by seasoned professionals. Without an effective strategy for preserving funds, even the most astute market analysis and promising trading signals can prove futile. The history of financial markets abounds with examples of talented traders who lost everything, not due to a lack of knowledge, but due to an inability to protect their capital. This is precisely why the principles of risk and money management supersede any technical indicators or complex trading systems. They form the foundation upon which stable and profitable trading is built. Everyone who seeks to achieve stability in the market must realize that capital preservation is the paramount task. It is not merely a precautionary measure, but an active strategy that allows one to remain in the game long enough to learn, adapt, and ultimately profit from market movements. Among the titans of Wall Street whose contributions to market understanding remain invaluable, Jesse Livermore holds a special place. His name has become synonymous with both grand successes and devastating failures, making his experience a unique source of wisdom. Livermore didn't just trade, he lived the market, studying its psychology and mechanisms with unparalleled intensity. His career spanned eras marked by significant financial crises and booms, enabling him to formulate principles that have stood the test of time. While his biography is full of dramatic twists, today we will focus not on his personal life, but on his unparalleled wisdom regarding capital preservation. Livermore understood that the ability not to lose money was the key to survival and prosperity in the market. His lessons, hard-earned through his own experience, serve as a guide for anyone seeking to protect their trading account from unpredictable fluctuations. In this video, we will unveil 3 fundamental rules of capital management formulated by Jesse Livermore. These rules are not mere suggestions, but ironclad principles that he applied throughout his career, and which, in his opinion, were crucial for safeguarding a trading account from losses. We will delve into each of these rules in detail, substantiate their relevance from Livermore's perspective, and offer practical recommendations for their application in your own trading strategy. Our goal is to provide you with clear, actionable tools based on the time-tested principles of one of the greatest traders of all time, so that you can not only preserve, but also multiply your capital. These principles are universal and applicable to any market, be it stocks, currencies, or cryptocurrencies. They will help you avoid common mistakes that lead to the downfall of many beginners and even experienced traders. Rule 1. Cut losses. Short. Jesse Livermore's first and perhaps most important rule is the unwavering commitment to cutting losses short. The essence of this principle is remarkably simple, yet adhering to it demands immense discipline and emotional resilience. It means that a trader must be prepared to exit a position quickly when it moves against them, preventing small losses from escalating into catastrophic ones. Livermore believed this was the only way to survive in the market in the long run. When the market moves against your position, it is a direct signal that your initial analysis was flawed or that market conditions have changed. Instead of hoping for a reversal, it is necessary to acknowledge the mistake and minimize losses. Many traders fall into the trap of holding on to losing positions, hoping that the market will turn around. This leads to a significant increase in losses, which subsequently become much harder to recover. Livermore emphasized that capital is your most valuable asset, and its preservation must be the #1 priority. Livermore's justification for this rule was deeply rooted in his trading philosophy. He firmly believed that the market is always right. If your position shows a loss, it is not the market that is wrong, but you. This axiom is fundamental to understanding his approach. Livermore did not try to argue with the market or impose his will upon it. Instead, he submitted to its signals. When the market moved against him, he perceived it as a clear indication that his initial hypothesis was incorrect. He famously said, "When I am wrong, I get out. And if I am not wrong, I can always get back in." This phrase perfectly illustrates his approach. There is no shame in admitting a mistake and locking in a small loss. On the contrary, It is a sign of a smart and disciplined trader. Preserving capital allows a trader to remain flexible and ready for subsequent, potentially profitable opportunities. Livermore also understood that every dollar lost on a losing position requires significantly greater effort to recover. For instance, losing 10% of capital requires an 11.1% gain to break even, while losing 50% of capital already requires a 100% gain. The larger the losses, the exponentially more difficult they are to compensate. The practical application of this rule for modern traders is obvious and critically important. The most effective tool for strictly limiting losses is the use of stop-loss orders. These are predetermined price levels at which your position is automatically closed, limiting your losses to an acceptable level. It is crucial not just to set a stop-loss, but to adhere to it unwaveringly. Many traders, seeing the price approach their stop-loss, move it further, hoping for a reversal. This is a fatal mistake that directly contradicts Livermore's principle. Discipline is the key factor here. A stop-loss is not a flexible tool. It is a clear boundary you set to protect your capital. Before entering a trade, you must determine the maximum loss you are willing to incur and set your stop-loss accordingly. This must be based on objective analysis, not on emotions or hope. For example, if you risk 1% of your capital on a trade and your stop-loss is triggered, you lose only 1%, not 10% or 50%. This allows you to survive a series of losing trades without depleting your account. Remember that capital preservation is not just protection, but the foundation for future growth. Rule 2, never average down on a losing trade. Jesse Livermore's second rule, which is extremely important for preserving a trading account, categorically forbids averaging down on losing positions. This principle sounds like an axiom. Never increase the size of a position that is already costing you money, hoping for a market reversal. At first glance, the idea of averaging down might seem appealing. If the price has fallen and you believe it will rise, buying more of the asset at a lower price will reduce your average entry price, and upon a reversal, you will break even faster or achieve a larger profit. However, Livermore considered this one of the most dangerous mistakes that rapidly destroys trading accounts, especially among less experienced traders. He saw how this strategy led to the ruin of many who succumbed to the temptation to double down on something that was already not working. This practice is based on hope and emotional bias, not on objective market analysis. It is an attempt to prove to the market that it is wrong and the trader is right, which, as we already know from the first rule, is a fundamental error. Livermore's reasoning against averaging down on losing positions was harsh and uncompromising. He asserted that averaging a losing position is the quickest way to destroy capital. When you add to a losing position, you are not just lowering the average price, you are exponentially increasing your risk. If the market continues to move against you, your losses grow not linearly, but at an accelerated rate because you hold a larger position size. This depletes your capital, reducing your ability to react to other, potentially profitable opportunities. Livermore saw this as a trap into which traders fall when they are unwilling to admit their initial mistake. The psychological aspect plays a huge role here. Accepting a small loss is difficult, but accepting a large loss caused by multiple averaging downs is much harder. This leads to emotional paralysis, where the trader becomes unable to make rational decisions, hoping for a miracle. Livermore insisted, never add to a losing position. That is the fastest way to destroy your capital. He believed that if the first part of your position is already showing a loss, it is a clear signal that you are wrong, and instead of deepening the problem, you should exit it. The practical application of this rule for traders is unequivocal. Avoid averaging losses at all costs. Instead of investing more money in something that is not working, it is better to accept the initial loss, close the losing position, and look for new, more promising opportunities. This allows you to preserve capital for trades that have a high probability of success. Imagine a situation. You buy shares of company X at $100 and they start to fall. Instead of buying more shares at 90, then at 80, hoping for a reversal, it is better to close the initial position with a loss, say, of $10 per share. This frees up your capital and allows you to reevaluate your strategy or find another asset that shows a clear upward trend. This approach not only protects your capital but also strengthens your trading discipline. It teaches you to admit mistakes and react quickly to market changes without succumbing to emotions. Every successful trader knows that the ability to quickly exit losing trades is one of the most important skills. It allows you to remain flexible, maintain liquidity, and always be ready for the next big market move. Continuing our examination of the second rule, it is worth delving into the psychological traps that compel traders to average down on losing positions. One of the primary ones is a cognitive bias known as confirmation bias. Traders seek information that confirms their initial thesis, ignoring signals that contradict it. When the price falls, they may cling to news or analytical reports that predict future growth, disregarding the current negative trend. This bias is exacerbated by the endowment effect, where traders assign greater value to what they already own, making it harder for them to sell an asset at a loss. Instead of objectively assessing the market situation, they allow emotions to take over, leading to irrational decisions. Livermore, being a master of market psychology, perfectly understood these human weaknesses and therefore categorically warned against averaging down. He knew that the market has no emotions, and a trader who succumbs to them is doomed to failure. Another aspect that makes averaging down on losing positions so dangerous is that it violates a fundamental principle of risk management: position size control. When you first enter a trade, you have likely calculated an acceptable risk based on your account size and your risk tolerance. By averaging down, you effectively increase your position size without reevaluating the initial risk. This means that every market move against you will now have a greater impact on your capital. Imagine risking 1% of your capital on the first part of a position. If you average down, you could double your risk to 2% or even more if the market continues to fall. Such uncontrolled risk escalation can quickly lead to catastrophic losses. Livermore always emphasized the importance of a clear plan and adherence to it, and averaging losses is a direct violation of any sensible trading plan. He taught that if you were not prepared to buy at a lower price initially when the price was higher, then why should you be prepared to do so now when your initial idea has already proven wrong? A real-life example can illustrate the danger of averaging down. Suppose a trader buys shares of company X, believing them to be undervalued. The stock price begins to fall due to unexpected negative news about the industry. Instead of closing the position with a small loss, the trader decides to buy even more shares when the price drops by 10%, hoping that this is the bottom. The price continues to fall, and the trader buys again when the shares have already lost 20% of their initial price. Now they have a significantly larger position, and their weighted average entry price is still considerably higher than the current market price. If the market does not reverse, their losses will be enormous. In contrast, a trader who adheres to Livermore's rule would have closed the initial position after a 5 to 10% loss, preserving most of their capital. This capital could then be used to invest in other assets that show an upward trend or to wait for more favorable market conditions. Thus, refusing to average down on losses is not merely passive protection, but an active strategy for capital preservation and maximization of future opportunities. This rule also underscores the importance of objectivity in trading. The market does not care about your feelings, your hopes, or your investment expectations. It moves according to its own laws of supply and demand, and trying to resist it by averaging down on losing positions is like trying to stop a train with bare hands. Livermore taught that success comes to those who can be flexible and adapt to market conditions, not to those who stubbornly cling to mistaken beliefs. Instead of fighting the market, it is better to accept its verdict and regroup. This requires courage, as admitting a mistake is one of the most difficult aspects of trading. However, It is precisely this ability that distinguishes successful traders from those who consistently lose money. Remember that your capital is your ammunition. Do not waste it on hopeless battles. Save it for those trades where the odds are in your favor. Let us consider another aspect: the impact of averaging down on a trader's psychological state. When a trader begins to average down on a losing position, they often fall into a spiral of negative emotions. Hope turns into disappointment, then frustration, and sometimes even panic. These emotions hinder rational thinking and lead to even worse decisions. The trader may start ignoring their trading plan, abandoning stop losses, or even increasing leverage, hoping to quickly recover losses. This revenge trading is one of the most dangerous phenomena in trading, and almost always leads to a complete depletion of the account. Livermore, who himself experienced several bankruptcies, knew well how destructive emotions could be, and therefore his rules are aimed at minimizing their influence on trading decisions. By adhering to his principle of never averaging down on losing positions, a trader can avoid this emotional trap, maintaining the clarity of mind and discipline necessary for successful trading. This allows them to remain objective even when the market moves against them, and to make decisions based on logic rather than fear or greed. Furthermore, averaging down on losing positions can mask the true state of the market. Instead of getting a clear signal that your idea is not working, you create an illusion of control by lowering your average price. This prevents you from objectively assessing whether the market has truly changed its direction or if you are simply fighting the trend. Livermore always sought market confirmation for his ideas. If there was no confirmation, or worse, the market moved in the opposite direction, he considered it a signal to exit. Averaging down, however, forces you to ignore these signals, clinging to your initial bias. This hinders learning from your own mistakes. Every losing trade from which you quickly exit is a valuable lesson. It shows you where you went wrong in your analysis or why the market did not react as you expected. Averaging down postpones this lesson, and sometimes even completely prevents it, as you continue to invest resources in a flawed idea instead of discarding it and moving on. It is important to understand that Livermore was not against adding to positions in general. He added to winning positions, meaning he averaged UP. This is a completely different strategy based on the market confirming your initial idea. If the market moves in your direction, it is a signal that you are on the right track, and then adding to the position can increase your potential profit. But averaging down, that is, adding to a losing position, is the complete opposite. It is an attempt to fight the market, not to follow it. This distinction is critically important and often ignored by many traders who confuse these two entirely different strategies. Livermore always emphasized that a successful trader must swim with the current of the market, not against it. And averaging losses is precisely swimming against the current, which inevitably leads to exhaustion and ultimately defeat. As we consider Jesse Livermore's profound principles, it becomes evident that his wisdom extends beyond mere technical aspects of trading, penetrating the very core of psychology and strategy. It is this wisdom that is explored in a book that has become a true Bible for generations of traders. Reminiscences of a Stock Operator by Edwin Lefebvre. This is not just a narrative about Livermore's life, but a deep analysis of his thought process, his mistakes, and his triumphs. The new edition of this classic offers a unique opportunity to immerse oneself in Livermore's world from a fresh perspective. It doesn't merely recount his story, it enhances it with unique commentaries and breakdowns for each chapter. These commentaries transform Livermore's experience into practical lessons, adapted for contemporary traders. You will not only read about how he made decisions, but also understand why he made them, and how to apply these principles in your own trading today. This is not just a book. It is a mentor that will help you avoid common pitfalls, develop discipline, and forge your own successful trading philosophy. It unveils the psychological traps we've discussed and offers ways to overcome them, based on Livermore's real-world experience. If you aspire not only to preserve, but also to significantly multiply your capital, this book is a must-read. It will provide you with the tools for deep self-analysis and improvement of your trading strategies. Do not miss the chance to access this invaluable wisdom. Click the link in the description below this video to order your copy of Reminiscences of a Stock Operator and begin your journey to trading mastery today. Rule 3. Maintain cash reserves and wait for clear market confirmation. The third, but no less important rule of Jesse Livermore, which is crucial for long-term trading success, is the necessity to always maintain cash reserves and patiently wait for clear market confirmation. This rule is the antithesis of constant trading and impulsive decisions, emphasizing the wisdom of patience and strategic waiting. Livermore understood that the market does not always offer ideal opportunities. There are periods of uncertainty, consolidation, or simply a lack of a clear trend. During such times, active trading not only fails to generate profit, but often leads to losses due to market noise and unfounded speculation. Therefore, he emphasized the importance of keeping a portion of capital in liquid form, ready for use when truly attractive opportunities arise. This means not being constantly in the market, but choosing only those trades that meet your highest criteria. Livermore's justification for this rule was based on his deep understanding of market cyclicality and trader psychology. He often said that money is made by sitting, not by trading. This famous phrase accurately conveys his philosophy of patient waiting. Livermore felt no need to be constantly active. On the contrary, he believed that the best opportunities arise only occasionally, and it is then that one must be prepared to act decisively. Maintaining capital in reserve is not just a passive action, it is an active strategy of protection against uncertainty. During periods when the market provides no clear signals, capital held outside the market is protected from potential losses. Livermore viewed capital as his ammunition. He did not want to waste it on small, low-probability trades. Instead, he saved his ammunition for large, high-probability moves when the big fish were ready to bite. He said, "Do not trade every day of the year." This does not mean he did not trade. It means he traded only when he saw a clear, undeniable trend. He never bought stocks that did not have a clear trend, as he understood that this only increased risk and decreased the chances of success. The practical application of this rule for modern traders is critically important in a world where there is a temptation for constant trading due to the easy accessibility of information and trading platforms. Firstly, developing a clear trading plan is fundamental. This plan should include specific criteria for entering and exiting trades based on objective market signals, not emotions. Secondly, traders must actively resist the temptation of overtrading. This means avoiding trading for the sake of trading, or out of boredom, or out of fear of missing out. FOMO. Every trade must be well-reasoned and conform to your trading plan. Maintaining liquidity is not just about having money in your account. It is about having a strategy that allows you to be flexible. Always keep a portion of your capital free so that you can capitalize on opportunities when they arise. This allows you to ignore market noise and focus only on high-quality trade setups. For example, instead of entering a trade with an unclear trend, wait until the price breaks a key resistance level with high volume, indicating a strong upward movement. This is the clear market confirmation that Livermore spoke of. Let us delve deeper into the aspects of patience and waiting. In today's world where information is instantly available and trading platforms allow trades to be executed in seconds, patience becomes a rare but extremely valuable quality. Livermore lived in an era when information spread slower, but even then he understood the value of waiting. He did not react to every market movement. Instead, he waited for the market to reveal its intentions. This means he allowed a trend to develop and then joined it. Many traders try to guess the bottom or the top, which is an extremely risky strategy. Livermore, however, waited for confirmation of a reversal or continuation of a trend before opening a position. This does not mean he missed the first part of the move. It means he traded with a higher probability of success because the market had already shown its direction. His approach was about catching big moves, not trying to profit from every minor fluctuation. Maintaining cash reserves also has significant psychological importance. When you have a substantial portion of your capital out of the market, you feel less pressure to trade. This allows you to remain objective and not succumb to the emotions of fear of missing out on profit, FOMO, or the desire to constantly be in the game. When all your capital is in the market, every minor movement against you causes stress and can lead to panic decisions. Livermore understood that emotional control is key to success, and having cash reserves is a powerful tool for maintaining it. This gives you the freedom to wait, the freedom to choose, and the freedom to act decisively when a true opportunity arises. Without cash reserves, a trader might be forced into low-probability trades simply because their money is idle, which is a direct path to losses. What does clear market confirmation mean in practice? It could be a breakout of a key resistance or support level with high volume, the formation of a clear price pattern, such as a head and shoulders, double bottom or flag, or the release of important economic news that shifts the fundamental narrative. The essence is that a trader must have objective, measurable criteria that signal a high probability of a certain price movement. This is not just a feeling about the market, but confirmed data. Livermore was a master at reading market patterns and volumes, and he waited until these patterns were fully formed and confirmed before entering a trade. This minimized his risk and maximized his chances of success. He did not try to predict the future. He reacted to what the market was showing him. This is a fundamental difference between a speculative gambler and a disciplined trader. Avoiding overtrading is another crucial aspect of this rule. Many beginners believe that the more trades they make, the more money they will earn. However, the truth is the opposite. Every trade carries costs, commissions, spread, slippage, and risk. The more you trade, the more you expose yourself to these costs and risks. Livermore understood that the quality of trades is more important than their quantity. He preferred to make fewer trades, but with a high probability of success and significant profit potential. This allowed him to focus on a thorough analysis of each opportunity, rather than spreading himself thin across many small, low-potential trades. Saving on commissions and avoiding unnecessary risks is a significant part of an overall capital management strategy. Furthermore, having cash reserves gives a trader the ability to capitalize on rare but extremely profitable events, such as market crashes or unexpected but strong trends. When the market panics and prices of quality assets drop sharply, a trader with cash reserves can buy at significantly more favorable prices, while those who are fully invested in the market have no funds to take advantage of these sales. Livermore was known for making his greatest fortunes during major market movements, often after significant declines. This was only possible because he had substantial capital reserves and the patience to wait for these moments. He was not afraid to be out of the market for extended periods, knowing that his capital would be safe and ready for action when the opportune moment arrived. Thus, Livermore's third rule is a call for strategic patience, disciplined waiting, and intelligent liquidity management. It is not merely passive waiting, but an active strategy that allows the trader to choose their battles, preserve their resources, and act with maximum effectiveness when the market clearly indicates the direction of movement. This is the foundation for stable and long-term success, as it protects capital from unwarranted risks and allows one to capitalize only on the best opportunities the market offers.